Hey everybody, Bentown here, and today I'm joined by my dear friend Megan Thompson to talk about business valuations in divorces and compare it to other kinds of valuations. So Megan, can you tell all of us, a little bit about yourself?
Sure. So I'm a forensic accountant. I'm mostly practice in Santa Clara County, doing almost exclusively family law. I do business valuations, separate property tracing, income available for support. Been doing this for this year will be my 21st year of working in this industry.
Your career can drink. Oh my God.
Yeah, I know. So I'm a CPA, I'm certified valuation analyst, and I'm certified in financial forensics.
Most of your business valuation work is in the divorce context. So unfortunately, two people are splitting up. There's a business involved. So why does this happen? And why is valuation part of a divorce?
Because businesses are community property if you start a business during marriage. So, I like to give my little caveat before I give a presentation, which is I am not an attorney, I'm an accountant. I can't give legal advice or make legal representations or opine as to the law. But that being said, I work in the law all the time. And as my good friend Ted Israel says, I can read. So, when we could read the case law and understand what it says and work with the attorneys to apply that law. But essentially, a business is an asset. It's an asset of the community. It's something that needs to be divided in a divorce.
Gotcha, gotcha. So when I do evaluation, and that's, as you know, basically what I do, exit planning, business valuations, all the things. But when I do them, it's for a range of things, usually, like I said, tax reporting, gifting, buying, selling companies. And so in each one of these instances, there's a definition of value that I have to adhere to in order to kind of know what the rules are, know what the rules are, know what the guidance is, and kind of know where you're going. And because of that, whether I'm using fair market value or fair value or strategic value, um, we know the rules as as different as baseball and cricket. Um, I know your world. I know just enough about your world to know that I'm not cut out for your world. But in your world, what value definition do you guys have to use?
So generally, we're using marital value. And marital value usually just means we're calculating the value of the business without any discounts or premiums. And that's really related, again, going into some case law here, but there's always argument on any type of analysis. But there is a case called marriage of Honer, and that sort of set the definition of marital value. And so that's kind of what we look to. But generally speaking, in valuing a business, you're looking for a hypothetical buyer and hypothetical seller. But in
Mhm.
family law, nobody's hypothetical. And so, we
Yeah.
know who, these are known entities. And so, uh, that along with the fact that there are assets that you would tend to include in a marital valuation that would not be included in a regular valuation. So if I'm selling my
Like what?
business, like cash, like
Hmm.
like accounts receivable a lot of the times, like shareholder loans can be included sometimes. So things that you would normally back out in order to get to a value for sale for
Hmm.
partnership agreement, something like that. Um, you include those in your marital valuation because if I have a pile of cash sitting in a bank account, it's part of the value of the business. If I were to give it to a third party, they're not getting my cash. But if I have a spouse, they own half that cash, so they get half of that.
Right. And thanks. I mean, you actually explained, the point I was going to bring up that, yeah, a lot of times you will exclude the cash or, conversely, I don't tend to play in the excess cash field, but, a lot of appraisers do. They have to decide what's needed for the business, what's not. That has nothing to do with you, right? Because you just say all the cash is, assuming the business is community property, all the cash is then owned by both.
Right. So, I mean, I will say that we do sometimes have to do that if we're doing sort of a capitalization of earnings method. So if you're using that, and you're not considering the assets in your valuation, then you would want to add in the excess cash to say, hey, there's more cash here than we would be, potentially be considering. There's different adjustments like that that you would make.
That makes sense.
Yeah.
Okay. All right. Now, because all of what you're doing in the business valuation arena is focused on family court. Uh, and all those rules are from court cases. And that all makes sense because that's in that little pond. Um, when I look at rules and guidance, it's really at, the Internal Revenue Code or GAAP guidance, and there are some court cases that are involved with that, certainly. Like I can read as well. Uh, like on the tax side in particular, there's a lot of court cases that are important. But coming back to you, really all of the guidance on what to do and how to do it comes from these court cases. So that's hard. Maybe explain why that's hard.
So I mean, the very basics of business valuation are going to be the same across, all forms. Like any type of business valuation, the it comes down to the analysis, and we all start in the same place. We're looking at cash flow, we're looking at assets. The things that change with the family courts will be things that are separate community property apportionment type things, which uh, there's case law that says if you had a business before marriage,
Hmm.
then technically that is your separate property. And the community can obtain an interest in that business, but it doesn't transmute, using legal terms here, but it doesn't change to be a community asset necessarily, unless you specifically do that. And so that's where we end up relying heavily on case law. Either the business was separate before marriage or it changed fundamentally during marriage, and trying to argue that there's a separate component there. So that's where a lot of the case law comes in. There's also the difficulty with the fact that this is a going concern with cash flow into the future.
Hmm.
And any value of a business assumes the cash flow into the future. So when you're doing a discounted cash flow method or something like that, the courts here, while it hasn't been tested a lot recently, generally speaking, most of our courts will reject anything that relies on a discounted cash flow method or anything that with projections into the future. I know we have some colleagues who have made some arguments as of late that this should be changed, and we're working to kind of educate the courts to explain that this isn't really it's not valid to reject these out of hand. So, but the way we work now is mostly looking at historical data. Um,
And why is that?
why is that? Because the anything that occurs after date of separation is the separatizer's separate property. So the courts have trouble differentiating between future cash flows that will be the separatizer's cash flows and historical cash flows, which you and I understand. The future cash flows are what drive the value of the business. That's where the
Right.
goodwill value is derived from. But when we start relying on projections, the court tends to not like that. It's just they have trouble looking at projections into the future, especially I would say in cases where projections aren't normally done. So we're dealing with a lot of small, closely held businesses.
Right.
When we're not, if you don't have a big business that's got a accounting department running projections, it's a guy who runs his construction business or whatever, the court sees the more reliable data to be the historical data.
Well, and it's totally understandable, right? I mean, from that standpoint, if you have this person who has never touched QuickBooks or whatever before and has their admin send the books over to their tax CPA once a year kind of thing, they're probably not in a great position to understand the financials enough to give you an accurate projection, even if they weren't biased. And of course, they probably are pretty biased, which we, in certain situations we all are, of course. It's of course our job to be independent and unbiased, but be very aware of where everybody stands in, as stakeholders in any issue. Again, that's also why I don't love personally doing a lot of litigation because everybody is just, on their own side. However, I love keeping people out of litigation for that particular reason.
Yeah. But if I had to guess on, why the courts lean this way, it is exactly that reason that, there is inherent bias that you can't be avoided on, there is one party who wants the business to be worth more. There's one party who wants the business to be worth less. And so to rely on the projections of one of those parties, that's going to be difficult for the courts to do, where we have this historical data that has been vetted by, probably a third party tax preparer, CPA, has been sent to the IRS, signed under penalty of perjury,
Right.
and it's reliable data. As long as, the cash flows are reasonable, why wouldn't we use that data for, determining our potential business value?
Well, yeah, that's absolutely right. And to your point, I mean, only one, a lot of times, only one of the parties actually has information about the business at all. The in-spouse has that, and the other party, the out-spouse, just doesn't most of the time. I mean, and certainly there, in a lot of situations, you have, both spouses in the business, but in a lot of other times, you'd have to be taking the word of it from one of the parties, and you can we've all been there. I mean, we can beat up projections all we want, but unless, excuse me, we can beat up projections all we want, but unless we really are starting from a reasonable position, we're just never going to get um, to the true answer or a reasonable answer.
Right.
Um,
And the other thing when you're in court, the goal, my goal is to have as few variables as possible for the judge to have to decide on. What we're
Right.
trying to do and is narrow the legal decisions that need to be made and make it so that our analyses are as clear and concise as possible for the court. So that's another thing that kind of differentiates what I do, is that I'm doing this for a judge. That's my ultimate goal, and the ultimate like reader of my information. I'm trying to make it so that they can understand it, number one, and can find a way to fit it into case law. And they can rule on it based on, I can present it to them based on what case law my attorney, the attorney for my client, is arguing.
so how does okay? That brings up an interesting point. How does that dynamic work? Because yeah, especially with some of you and some of our colleagues, and had a lot of discussions around, hey, we're really trying to assist the court, and yet at the same time, you're generally being retained and paid by one side or the other.
Mhm.
Although, of course, the joint retention thing was a big question we were talking about recently. But usually, yeah, somebody is paying one side or the other expert to have to do the work, have an opinion. I mean, maybe you can talk about the dichotomy there, and hired guns and all that stuff.
Yeah. So, like, the bottom line is, I'm an independent expert. I say that to my clients very often. I am an independent expert. I am not hired gun. I am not your advocate. That's your attorney's job. So, if you come to me and you say, hey, I want you to make this value as high as possible, and I want you to put this here and put that, I'm not doing any of that. That is not happening. I will not do just whatever my client says. What I will do is work within the parameters of the law and the reality of the situation, and work with the attorney who is making a specific legal argument. And then what generally happens, especially if there's two sides, so I'm the expert for, wife, and the other expert is for husband. We will often have a meet and confer, where we meet together and we lay out a very simple side by side for the court that says, we agree on all of these things. So we're not even discussing them. They're off the table. We agree on, the inputs, the net income, all this stuff. We disagree on replacement compensation. It'll be like one thing. And here's our difference. and here's why. What, they think that, their client is a very common example. My side said he sleeps at the office, he's working there all the time, he should, the replacement compensation should be very big. Or, the client says, I only work 20 hours a week, really, we should reduce it by a lot.
Mm,
And the two experts are getting very different information from the different clients. I had this in a case once where I was the courts expert, and I had a meeting with husband, and he said one thing, and I had a meeting with wife, and she said a completely different thing, totally different realities as to how much the owner spouse was working in the business. And so in that case, there is no right answer for the experts. So the experts have to present that to the court, and then it's up to the parties to plead their case to the judge and say, hey, this is my reality, and the other one says this is their reality, and the judge gets to decide those things because there's no coming together on that.
it- right, just two different positions, and the trier of fact needs to
Yep,
get to the fact.
get to
Um,
the fact.
the so stuff like replacement compensation. Um, why would somebody on one side or the other want a higher or lower replacement compensation? What does that really mean for the net result?
Right. So I mean, if your replacement compensation is higher, it reduces your cash flow. And if your replacement compensation is lower, that increases your cash flow. So, the party who wants the business to be higher is going to likely be arguing for a lower replacement compensation. I have had this discussion with attorneys where, I'm trying to explain that to them and, in terms of them arguing, well, well, I want the replacement compensation to be much higher. And I'm like, do you? But it should be whatever the reality is. Like that's the answer. And then that dovetails into potentially income available for support. And so you have to keep those things in mind. While business valuation is its own silo, we also have this issue of support. And so those often work together. There are multiple cases, I can think of, like the marriage of McTiernan is a very famous case that was, he was, a director, right? Director of, he did of big blockbuster movies. And the courts basically found that his business isn't worth anything. He's a guy with a clipboard walking around. You can't replace him. And basically, his replacement compensation would completely wipe out any value that would have to this business. But pretty sure his support award was pretty high. So it's,
Right.
those things kind of go together. And so you have to keep that in mind when you're valuing the business.
Well, yeah, absolutely. I feel like I have to tell some clients that fairly often that your business doesn't have any value, but good news, you do. That's the important part. I mean, in fact, that tends to apply to people like us, where our firms aren't worth a ton, but it's really what we do and what we bring personally to the situation that's useful and valuable.
Right. The
So,
general mantra from the client is, without me, this business wouldn't be worth anything. That's always
of
like,
course, of course. And of course, always bearing in mind what their bias is or what we think their bias should be, because maybe they don't understand it very well. We don't always know. Okay, so you know what? Let me get to this. The In family law business valuations, there are definitely some key issues that are different from what I do. Things like the valuation date, this data separation, data trial, service versus manufacturing business, different definitions of goodwill. You've kind of alluded to that, and then you actually just talked about the double dip issue. So those were some of the things I think we were talking about before to kind of to bring out.
yeah. Where do you want to start?
Yeah, I mean, yeah, talk about maybe the dates.
The date.
What dates are important?
Generally speaking, assets are valued at date closest to trial. So that is the date that your default date for valuing a business would be the most current date that you have available. Um, However, there is a way to petition the court to ask for an alternate data valuation. And that is usually done, and this, now we're getting into like legal issues on that, where a service business may be a type of business where you ask for an alternate data valuation at data separation instead. There may be other alternate dates that you would want to look at depending on, what happened within the company. But usually it's because after data separation in a service business, whether the business goes up in value or down in value, it's due to the separatizer's efforts, or it can be considered due to that separatizer's efforts.
So the separatizer, I mean that sounds like a really crappy action movie, but what does that actually mean?
That's just the owner of the business, the person who's running the business, they're now, it's their separate property. So when you're married, the community, community income based on your time, labor, and skill during marriage. That's how you acquire community property. That's how you acquire community income. When you're working, if I'm working right now and I'm making, my hourly rate, half of that hour is my husband's rate. He, even though he's not doing my job, 50% of what I earn is his. Unless you have a prenup, not going to get into that. But that's how community property works. Once your date of separation is established, everything after that date that you earn is your separate property. And so the courts have tended to consider the efforts after date of separation. Again, going back to that discussion we were having about why they don't like a DCF or a discounted cash flow method, is that once that person is working after date of separation, should those efforts be continued to be considered as part of the value of the business? Now, it's a community asset, but it's also running because this person is running it. So, and then we get into replacement compensation, whether that just accounts for all of that. But the big problem that we tend to run into is the person after data separation has complete control. So they can decide not to work anymore, and then the business goes off a cliff,
Worth nothing, quote
worth
unquote.
nothing anymore because they haven't been putting in any effort because they want to try to reduce the value of the business. Or something happens after data separation and all of a sudden the business is worth a ton. Does the community get to participate in that, even though it was something that the owner did after data separation? It's not clear.
Gotcha. And that doesn't necessarily have to do with how you go about the measurement, right? That's kind of an argument for the attorneys, and you're giving them information about what that might do to impact their argument and how they would want to argue the situation. Uh, but you basically get to, hey, this is what the value is on this date with this set of assumptions, right?
Yes. Mhm.
Cool. Can you talk about Goodwill a little bit?
Sure. We talk about the Goodwill.
Yeah. Well, I mean, I think first off, I think you guys in family law use the term goodwill quite a bit differently than I do potentially.
Potentially.
It could be, yeah, yeah, exactly. It could be the same. And there's a bunch of overlap and at certain times and sometimes not. So how do you use the term goodwill? What does it mean in the context of a business? And
Yeah.
yeah, all that.
So when we're looking at Goodwill, we're looking at the amount of income generated, or not the income, the value of the business that's generated above and beyond what the assets are generating. So, because usually what I'm doing is an excess earnings method, because that's what the courts have accepted for a very long time, and so we continue to do that.
Mhm.
But what we're looking at is, the cash flow, with a discount or with a capitalization rate applied, and that multiplier becoming our goodwill portion of the business. Uh, there are states that I know of because I did a presentation for the AICPA where we did a panel discussion with different forensics in different states, and they differentiate personal versus enterprise goodwill and actually pull out personal goodwill from the business, saying that that is an asset of that's a separate asset and it needs to be not valued as part of the community estate.
Hmm.
My understanding of California law from what I have done mostly, there's always argument against things, but is that personal goodwill is part of the community estate. So we don't separate the two. We don't back that out. Um, and in terms of calculating what the uh, the separatizer's portion would be, rather than calculating what good personal goodwill is, we would be calculating a replacement compensation. So that you have to be
We
very,
account for it differently, basically, right? I mean, I
well,
certainly account for personal goodwill differently or separately, I guess, than trying to back out a particular number or quantify it specifically.
right. We don't quantify a personal goodwill specifically in California for family law purposes. In
Right.
other states, they do. That's
Well, that's
my
cool. That must have been a pretty cool panel, though, hearing everybody together. I mean, must have been pretty big too.
yeah. There were like 1,000 people in the audience, so it was pretty
That's crazy.
crazy.
Was that live or was that Zoom or what was that?
It was a Zoom. It was a Zoom
Okay.
presentation that we did in February 2025.
Oh, dang. Okay. I
Mhm.
missed it. Why did I
It
not
might
know?
rebroadcast. I don't know.
Okay.
It was pretty fun. It was a good one.
Excellent. Excellent. That's cool. Um, okay, so we touched on like things like the double dip, where there's different components about that compensation. So, but there are some things about business valuation, and we touched on this for Goodwill, where there's, easily recognizable stuff between what I do and what you do. You could pick up my report and, easily understand what's going on there and vice versa. Even though a lot of some of the detail and some of the rules are different about how we do things. So like, what, I mean, maybe we can just chat a bit about, some of the things that are the same. We already talked about replacement comp.
Mhm.
Um, we handle things like related party transactions. So when it's not an arm's length transaction. So for me, usually what I do is we need to back that out. But maybe you can add some flavor from the family law side.
Sure, yeah. So related party transactions, depending on what they are, we would generally back them out. But the thing that you have to remember, so things like, especially with shareholder loans,
Hmm.
we have to then not forget about them. And that happens a lot, is that you'll back them out of the business valuation because you're normalizing the balance sheet and pulling
Hmm.
out third party loans, but that's still a liability or an asset, whichever way you're going,
Hmm.
of the community. So if the community put money in to this business and now you're pulling out this loan that they gave to the business,
Hmm.
that's something that they should still get paid back for. So sometimes we'll just leave them in and have it be part of the business valuation. But usually we'll pull it out, normalize it, and then I have to kind of remind the attorneys not to leave that on the table, not to forget. So if it's like, $250,000, that's not small potatoes. That's something we want to address
Right.
in property division. There's a lot of if you've ever worked in it with a closely held business, there's a lot of weird stuff that goes on.
Can
So
be.
yeah, have you ever done that? But there could be family loans. I've had things where there's other businesses that are unrelated and are maybe would be considered a hobby. That happens fairly
Ever.
often. Someone's, I had one where someone was sort of funding their art, so the business was doing great and it was lending all this money to this other business. And then when we're doing the property division, we have to remember, because usually when there's a business that has a big negative value, we just kind of like ignore it. You don't usually have someone buy out the
Right.
other. But this is real money that went from one business to another, and we need to think about accounting for it.
Right. Because I mean, family court is, what do you call it? Court of equity.
Part of equity. Yep.
Right. Yes, got it.
Yeah.
So meaning that, whereas I might not need to think about other stakeholders and other sides of the equation outside of the valuation, although we do in a lot of other situations, but it's not the same as, hey, if you take it out of here, you got to put it in there, like you're talking about, the shareholder loans and kind of other. were you being fair to the community and those types of discussions? That's not really a discussion we have for, an estate tax filing or something.
Yeah.
It's just, hey,
You don't
what's the
have a
what's
breach
the
of fiduciary duty issue on that
right,
one.
or at least not about the valuation, generally
Yeah.
speaking. But yeah. Okay, cool. Well, let me ask how it is early 2025 now. You've just done your major national speaking event, and you know what I don't hear anymore is any talk about COVID, which is perfectly fine by me, by the way. But we're not that far out from that period. I mean, it started in 2020, and depending on who you talk to, it ended in 23 or early 24. Um, and there have been impacts on businesses. So what are some of we both have had to deal with this. We're both practicing through, right through. Um, what are some of the common things that you saw in your that were problems in your business valuation practice side of your practice due to COVID?
I think so I mean there's obviously the sort of regular stuff that needs to be adjusted out, the PPPs and the SBA loans that people took, things that were forgiven, things that are anomalous items that would need to be backed out. But in like general, we saw in most businesses or a lot of businesses either a spike or a dip in income. I mean, that's what we're seeing across the board. Some companies did crazy business. There seems to be sort of a consensus among people that, oh, all businesses suffered during COVID, and then that is not true. There were a lot of businesses that I saw that just did amazing during
Mhm.
COVID. So you have to consider that in the same way you consider the ones that, dipped during
Mhm.
COVID.
You were
And
selling webcams, you were on it.
exactly. Yeah, how did Zoom do during COVID? Come on. There's just like businesses, I saw like a lot of construction businesses did really well.
Yeah,
Uh,
or at
depending
least for
on
a
what
period of time. Yeah.
Well, and depending on what kind of construction you're in. If you're in home construction, people are sitting in their houses, hating their lives, wanting to fix up. I know I was one of them, fixing up my bathroom. Being like someone in here being like staring at my bathroom all day, being like, I gotta get that fixed. And the construction guys were doing the construction businesses were doing really well. Um, if you are commercial construction, maybe not as well. If
Mhm.
if you own a bunch of commercial properties that you're renting out, also not great. Like
Sure.
so you have to look at that. But we also had to look at whether they had government assistance that replaced that income. I think that's a big piece that we need to dive further into when we're looking at certain companies is, they got assistance, you can't just automatically back all of that out because some of it was replacement and it sort of normalizes the income statement. That's what I was seeing. Were you seeing similar things? How are you dealing with that right now?
That's really interesting because obviously everybody had to deal with it in our industry, period. And everybody kind of had their, there's some pieces of it that I think everybody agrees with, and some pieces that are, specific to how we do. I mean, one of the things that I tended to do was kind of skip it, if to the extent that there was, um, a noticeable break from normalcy in that year. Well, also, I get to get I have the advantage of almost always needing to look at expectations, look at, forward-looking earnings. Um, so I can say, hey, look, that was unusual. How do we get to that realistic expectation going forward? What does that look like?
Yeah.
So sometimes we were looking at 2019 results to see, hey, in a quote unquote normal year, or even before that, especially early on, what do you do? I mean, especially as we got later and later, where, if there were companies that were going to go out of business, they already had. And if, everybody else was going to be a survivor at that point, we're very likely, such that we could say, okay, well, let's get back to what does normal look like, period. No matter what 2020 or 2021, 22 did. So
Yeah.
that was that's how we do. I'm just looking forward to 2027 or so when we can look 5 years back and still not have COVID, too much COVID in there. That'd be good.
Same. I think you're right that it's almost easier on the companies that sort of dipped during COVID than the ones that spiked because
Hmm.
trying to adjust for like and normalize that is really speculative, I feel like. And with the dips, I can just kind of, you know, it's easier to justify just kind of not waiting that year or waiting it differently
Right.
or something. Whereas if it spikes, especially if you have a party who is looking to have a higher value and trying to explain to them why that doesn't belong in there, is a
And it
little
may not just may the company may just not be worth that anymore.
right.
Even if they were at the time, which is an arguable point anyway, but even if they were, they're certainly not now because they've come back down to normal.
Right. And I think this is something where we definitely would diverge on this is that I'm dealing
Mm,
with a lot of people who uh at this point in time were separated maybe in 2022 because we have, you'll have a data
mhm.
separation. And
Yeah.
so if you have a data separation in 2022 and you're dealing with 21, 22 as your like last year is just before
Mhm.
data separation, and then starting in 23, something changes. How do you know whether that's because COVID's over or whether that's because that's data separation? And
Right.
either party is going to argue something different. And so that's where it becomes a little bit trickier, I think, in the family law arena.
I don't envy you that. Uh, well, so okay, talking about those businesses that you're working with, and yeah, bearing in mind that you do have a lag a lot of times, looking at the date of the data you're looking at because it takes so long to get through the court system. And I'm usually not looking that far back, or at least I try not to. Um, what kind of businesses are you working with? What sizes, industries? I don't know. What about your practice?
Sure. So, I mean, mine's mostly small, closely held businesses. A lot of, dentists, doctors, construction, things that just yeah, small, closely held businesses. So the one of the things that I do also is something called a sensitivity analysis a lot of times, where we kind of look and say, is this a business or is this a job? That's
Hmm.
kind of how big the businesses are sometimes I'm looking at, where, I check to see whether their cash flow exceeds their replacement compensation. Like essentially, and said, is this even worth valuing at this point? So the problem that we run into again with family law is at, you have to divide all assets. And so if you have a business is a community asset to be divided, and someone's going to want to know what the value is of that business and whether it's worth anything or whether it's not. And so you have to assess these things. And so I tend to have also smaller engagements where even though this business isn't making $1 billion a year, someone needs to know what the value is. So
It is definitely significant to the people involved.
yes, exactly.
Absolutely. Um, okay. And considering that you work with largely with small businesses, I mean, what are some of the big issues that you do encounter when you're trying to value them? I mean, we've gone over a bunch of them, but anything else? Like, is there a secret gotcha or a just something hidden that people wouldn't think about in the as an issue in this area?
Yeah, I mean, I think the biggest thing we have is personal expenses being run through the
Oh,
business.
of
I
course.
mean, that's huge. That is, whether we have to dig into the books and really like assess every single personal expense that you're using. I mean, I have people who paying their mortgage through the business, maybe, or, I had a guy where, we found a Louis Vuitton purchase and we're like, I don't think that that's a business expense. That
I don't think that
doesn't
was for the wife.
yeah, well, that doesn't seem ordinary and necessary to me. That would be cool. I would, but so just things like that. I mean, I've seen some egregious personal expenses. Uh,
Right.
you know, not, exactly what you alluded to. This was not for the wife, that kind of stuff. And in that case, then we not only have like an add back for the business valuation, but potentially a reimbursement claim for the spouse that paid for it. Um, we also, uh, I mean, people will run anything through. Sometimes you find some, and then I do get squeaky clean books every now and then.
Uh,
But more often than not, I have to do somewhat significant add backs.
I have kind of a personal theory about this that you end up getting more. I mean, there's a size thing too. I mean, the smaller businesses often have more just crazy stuff in their books. I do wonder if the people who if there is a correlation between divorce work and crazy crap getting put through the books and all the other purposes for valuation and having clean books.
Yeah.
Uh, I don't know. There may be
I
a
mean,
psychological
that's a
study
good,
there.
yeah, that's a good point. I mean, the other piece of that is the accuracy of the books and like what I'm getting. So I'm sure, in a bigger business, I usually get pretty good records. I'll get
Mhm.
QuickBooks, or I'll get, something, a big general ledger or something like that that I can rely on. The smaller you get in the business, the more it's I took my bank statements at the end of the year and I added up all the deposits, and that's my income. And then I just kind of guessed on the expenses or whatever.
Right.
And then you get to the point where, you know, they've submitted this to the IRS and that's what they believe is accurate. How accurate is it? Number one. And number two, I now have a mess on my hands for a business that's probably not worth very much. How much are you going to spend to have me recreate your books for 5 years? I mean, that's just not cost effective. And so that's another thing I think that I have to consider that you don't necessarily have to as much, is that I really have to give my clients like a reality check about a cost benefit of pursuing certain things and say, hey, yeah, we could go in and add back every single expense. We could go in and, reopen the books and sit there and go through it with a fine tooth comb. Uh, how much are we going to get out of that versus how
Mhm.
much you have to pay me to do that? And that's not always a net positive.
Well, I mean that is a really good thing. I think I don't have a direct corollary for what I do. Sometimes what we talk about is like maybe in a gift and estate scenario, just kind of giving just a super top level uh, back of the napkin talk through of what value could be so that people can go off and make some plans around transactions and that kind of thing. Uh, but I don't have to defend none of that in court until at least not until I do the valuation and sign off on it, and it becomes a part of the tax return.
Right. And
Uh,
I think the other issue that springs to mind when you say things like that is when you're working with these people, there's a business that's established and someone's been running it and it's all kind of above board. When you come to me, trust is gone.
right.
So it's really hard to overcome that piece as well, to say, well, here's the books I got. And they say, well, I don't trust this person at all anymore.
Hmm.
How do I rely on what they've given you? And so we have to kind of, make sure that we're checking against supporting documents, or, making sure that the client is, on board with what the books say, or,
Hmm.
anything in that respect.
And from that standpoint, it's totally similar to like a partnership dispute or
Yeah.
yeah, a lot of situations like that.
Yeah.
But yeah, I mean, even a little more personal, obviously, when you're talking about a spouse.
Mhm.
Okay, I could just chat with you all afternoon here, but we can't do that because we actually have real work to do. Two last personal questions.
Okay.
Okay, so why do you find what you do rewarding?
Oh, so there's two reasons why I find it rewarding. I'll say the more selfish one first, and then I'll go into the other one. Because I love puzzles, and it is very interesting to me to put together all of the pieces of things and come out with an answer and like understand it. So like to relate that to other accounting professions,
Hmm.
when you do a general ledger, like, or a general journal entry, and you get to the bottom and it's zero, and you've nailed the like the allocation and it's perfect, or your T account, that's to me, that's the
That's
great,
what makes us CPAs. Yeah,
it's the
exactly.
greatest amount of satisfaction. I don't understand why other people don't think this is amazing.
The best thing.
But like that's like I love like put like someone has a separate property claim and I'm tracing it through and I figure out where it went and it goes to their house and here's their claim and now I have an answer and I've put together all the pieces. So
Mhm.
that's the first thing. And the second thing is like, a lot of people will say to me like, how do you do divorce work? Like it's so depressing or whatever, or how can you, or on the other side, how can you take advantage of people who are getting divorced? And my response to that is
Oh.
like, my job is to help people who are already going through this process. I'm not telling them to get divorced. They're not, they've decided on their own that they need to do that, to start this process. They're getting divorced. I am there to help them get through it as painlessly as possible in terms of the financial aspect. They have these financial issues and they need to resolve them. And my goal is to try to get them through this process quickly, efficiently, as cost effective as I possibly can. I tell my clients like I'm not trying to make my work more. I don't need more work. I don't want more work. I mean,
Yeah.
it's always nice to have work, but I'm a little bit up to my eyeballs at the moment. So I, I want to help them get to a place where they can be done and through with it and be like, I've resolved everything. Maybe I didn't get everything I wanted, but I have gone through this process and I am on the other side where I need to be. And that Megan helped get me there.
Well, hopefully that means you have, at least on occasion, a few satisfied and grateful clients.
I do.
Fortunately
It's
now, since I
actually
don't, well, go ahead.
no, it's actually really nice. Like a lot of people have like thanked me for my work, which you wouldn't really expect. I'm a financial person, like what, but like have said, nice things to me. Some people have said mean things, but like a lot of clients have, said, thank you so much for your help with this process. It's been really helpful. Like you in particular have helped me through. So
Absolutely. Totally believe it. Okay, so the second question. Sorry,
okay.
just so the camera knows. I mean that was sincere, not sarcastic. Um, second question. Second to last question. What are you reading right now?
Ooh, oh God. What am I reading right now? I don't know. I'm reading like is this like supposed to be like a business valuation thing that I read?
No, no, no. This is a new question that I'm just popping in because I'm interested.
Okay, I will tell you, but it's gonna be bad because I'm a basic B. Anyway, I'm reading right currently. I am reading Onyx Storm, which is a
Yeah, Fourth
uh,
Wing. Okay.
fourth wing
Mhm.
dragon book. Yes, so
Okay.
that's because when I like I either watch TV or I read because I need to turn my brain off, and
Totally.
that's the thing that I'm reading currently.
I listened to that too. Well, the first one on Audible, and man, that was racier than I knew what to do. Tell you what. Uh, yeah. Okay. That was definitely old school fantasy in that regard. I did read Cat's Cradle at your
Oh,
recommendation the
oh,
other day. I finished that up. So that was weird but cool.
yeah, so then to redeem myself, I read every single book I believe that Kurt Vonnegut has ever written. So
There we go. There we go.
I think that he's my favorite author of all time. I'm also about to start a book of Philip K. Dick short stories. So
Oh, he's great.
I love Philip K. Dick. I
That's
love
complicated stuff right there.
yeah. So I'm, a little bit of redemption there.
Good stuff. Okay, I'm sorry. And with that diversion, let's just bring it back to where could people find you? Obviously, they can find you on this video. Uh, but if somebody wanted to reach out and talk to you about some business valuation or family law or whatever, how could they do that?
Yeah, so I guess I mean it was send me an email. That's the easiest way. Megan at thompsonaccounting.net, Megan at thompsonaccounting.net, or you can find me on LinkedIn. I am not very good at checking it, but if you find me there, I will give you my email at that point, and you can email me as well.
Of course, somebody can always reach out to me and I'll know where to find you.
Sure.
So, okay. Well, thank you very much for coming on and, just chatting with me. Appreciate it.